Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast to our series of interviews with leaders and luminaries from the financial services industry, exploring trends and opportunities in global financial markets in 2025. I'm joined today by my colleagues Brian Murphy, who's a partner in our U.S. corporate practice and co-leads our technology and financial services group, and Frankie Tam, a partner in our tech and data practice in Asia. And I'm your host, Sierra Nicholson, Global Strategy and Development Lead for the financial services sector. Brian, Frankie, welcome. Thank you both for being here. We've just listened to our colleague Matthew Allen in conversation with Carl Hollingsworth, who's the Chief Legal and Corporate Governance Officer at Mox Bank, which is a digital bank in Hong Kong. And they covered a lot of ground on the topic of digitalization. I'm really excited to be talking to both of you today and to hear your hot takes. Brian, I'm going to come to you first. So Carl talks about the difference between the way digital banks in Hong Kong evolved versus other parts of the world. In Hong Kong, the digital banks all started as legacy banks, and so they were subject to banking regulation from the beginning. The challenge, therefore, being that it's difficult sometimes for them to achieve the balance between the regulatory requirements that they're subject to and innovation. Whereas in the UK and Europe, Carl was saying that the digital banks often start as other kinds of businesses, mainly fintechs, and so they have more agility in those early days in innovating and testing before getting a bank license and being regulated as a bank. So it was a long preamble, Brian, to say that I'm really interested to hear from you in the U.S. perspective on that kind of same topic. So can you talk about the evolution of digital banking in the States, which I think is maybe more like what Carl describes in the UK and Europe?
Yeah, sure, Sierra. And first off, I'm excited to be talking to you about these topics as well. Yeah, so from a U.S. perspective, I mean, of course, traditional banks have been digitalizing their products and services for a long time now. But I think here we're really talking more about these digital or mobile first challenger banks, or sometimes they're called neo banks. And I think in the U.S. the experience is more similar to what Carl described as the experience in the UK and Europe, and that most of these sort of neo banks probably started more from a fintech starting point than a traditional licensed bank starting point. And in fact, a popular model in the U.S. is the banking as a service model, right, where the fintech will partner with a traditional licensed bank to effectively white label and resell and distribute the bank's products and services. So I think a lot of the digital banks here in the U.S. either started with that model and then eventually moved towards getting their own banking license, or frankly, a lot of the digital banks operating in the U.S. operate under this banking as a service model, where they are technically financial technology companies, and they are, again, white labeling and reselling via their platforms banking products and services that are ultimately provided by licensed banks. For example, Chime's banking products in the U.S. are provided by Bancorp Bank and Stride Bank. Revolut operates in the U.S. offering bank products from Lead Bank and Sutton Bank. So yeah, I think definitely more similar to the UK and Europe experience than what Carl described as the Hong Kong experience.
Another thing I was interested to hear Carl talk about was the structure of Mox Bank. So it's a joint venture between Standard Chartered, Hong Kong Telecom, and I was very interested to see Trip.com, which is a travel agency. I know in your practice you've worked on a lot of JV structures with clients. What are some of the digital bank structures or other bank structures and partnership models that you're seeing in the market right now?
Yeah, so I think we've already mentioned the first and maybe the most prevalent, which is that banking as a service model, which is a very popular structure. And that model, I think, at least in the U.S., is probably less popular of a model with some of the larger national banks, right? Because they've already got huge brand recognition, extremely large customer bases, and frankly, they're under increased regulatory scrutiny, and there's been a lot of focus on third-party relationships, so that can make the banking as a service model riskier for them. But other banks, some of the smaller and medium-sized banks, this banking as a service partnership, it can create really great new channels for distribution for their banking products and help them appeal to populations of customers that they may not otherwise attract. And then on the fintech side, right, the fintechs can step in and kind of work their magic to add digital first customer interfaces and other tools that give their customers the ease and convenience of a digital experience that they want. And they can also, frankly, help accelerate the digitalization of some of the smaller banks' banking products. So that's a really popular sort of partnership model here in the U.S. The model that we're seeing sort of in the digital financial services and banking space, that's been a really hot topic over the last year or two is embedded finance, and that's a model where banks and fintechs and sort of and oftentimes sort of consumer recognizable brands are teaming up to offer banking and financial services that are traditionally provided by legacy financial institutions, and in some cases have to be because they're licensed products and services through consumer-facing brands and other companies that traditionally have not been in the financial services space. Like sort of a generic example of that might be like a popular mobile-based app, right, that wants to sort of further engage either with their customers or with their gig workers. And so they may offer things like payment products and services or even banking accounts that may be branded with their brand. But at the end of the day is sort of supported through a web of fintechs and banking partners. It can be a great way for the brand to create, different ways to engage with their customers and create stickier relationships. It can also create really novel distribution channels for the banks for their products and services.
That's an interesting sort of convergence of industries, right? And there's just so much opportunity, it seems like, with the broader digitalization of the world and like consumer expectations changing for legacy financial institutions to kind of tap into these new customer bases or even product offerings. One last one for you, Brian, before I move on to Frankie. Let's drill down a bit into the topic of balancing regulation and innovation. So Carl shares observations on some of the challenges that the digital banks in Hong Kong have had in achieving that balance. I'm just curious to hear from you what 2 or 3 things you would put at the top of that list.
Yeah, so over the past couple of years, at least in the U.S., as I mentioned, there's been a huge focus on banks by their regulators and their third-party risk management. And in particular, this banking as a service model has been under increased scrutiny by the regulators, right, who are concerned that the banks may not be exercising proper oversight and controls over their programs with fintechs and neobanks. And so, and really, this focus kind of or concern culminated last year with the collapse of a fintech called Synapse that resulted in hundreds of thousands of consumers not having access to their funds for a prolonged period of time, right? And so, I think the FDIC and other federal banking regulators have really sort of put a focus on those concerns. But despite that regulatory pressure, right, these bank and fintech partnerships and digital banking relationships, are still remain popular and strong. So sort of within that context, I think a couple of friction points, right, between the drive for the fintech side of the program or the company or the organization to want to innovate, versus the sort of regulatory pressures that the banks are under. A couple examples of those include, maybe the first one that comes to mind is data use, right? And so the fintechs, right, they're coming out of an environment where data is currency, right? And so they're really interested and really good about thinking of different ways to take user and customer data, right, and particularly that data coming out of the experiences they're having within the maps and within the mobile apps and their digital environments, and using that to develop new services, new ways to engage with clients, and try to create these stickier, more pervasive customer relationships. But that really rubs up against sort of privacy concerns and privacy protections for consumers. And those privacy regulations are of particular focus for financial services. So again, you get this tension between the fintech side of the solution that really wants to have access to and the ability to use all the data they can versus restrictions on what regulated banks can share and how the data that they've been tasked with protecting can be used. So, an example of that is if you've got a banking service that's being marketed by a consumer recognized brand, right, and to their customer base, they're in a lot of ways and you can understand they're going to view that customer base really as sort of their customer, right? They're bringing the customer to the solution. Why would their customers' data not be theirs to control and to use? But the reality of the matter is that when a banking product is involved, the banks, that data, at least coming out of the use of that banking product, is the bank's data and the bank's obligation to protect. So, as you can imagine, there's some tension there that may require some creative solutions.
It definitely sounds like it. You're bringing together two very, I would say, culturally different types of businesses, right? Like, fintechs move fast and break things, and banks definitely don't want to do that. So it's interesting to kind of think about, though, for what you're saying about the complexity of like what ultimately ends up in the market. Probably consumers are not aware of the like web of complexity that's behind that easy, user-friendly, like, digital bank or what, other embedded finance or whatever product they're ultimately dealing with, right?
That's absolutely right, right? Like to take an example, like let's say a digital bank and applying for an account where the consumer enters their information and within a matter of seconds they get a decision back, right? Well, there may be 3, 4, 5 parties in that chain of decision making and setting up that account behind the scenes, and it's really amazing how once it's put together correctly, it can work so quickly and so seamlessly. But there's a lot going on behind the scenes.
Yeah. Yeah, a lot to kind of think about.
All right, Frankie, sticking with the risk and regulatory theme, one of the risks that Carl mentions as being in sharp focus for regulators is that of third-party risk management. You've worked with a lot of you've worked on a lot of tech outsourcing transactions. What are some of the challenges your clients are facing as related to third-party risk and data security?
That's a great questions. So we have been advising our FS clients and banks on many technology transactions, and the challenge is really that only the banks and the financial services institutes are licensed and regulated by the regulators, while their third parties, partners or vendors, they are in the technology sector and mostly they remain unregulated. So ultimately, it's the banks and the financial institutions that shoulder the burden to comply with very different regulatory requirements across using technology, software, data center, as well as handling data. And to manage these risks, we have seen our clients use various tools to mitigate the challenges and the risks brought about by them, including undertaking risk assessments and doing due diligence before onboarding the third-party vendors or partners. However, these kind of risk assessments and due diligence process do have a limit. For example, from day one, when there is this cooperation of technology transactions enter into between financial institution and their third-party vendor or partner, is on the basis of this vendor, their state of sophistication in adopting good technology and secure measures to protect data. But as it develops, most of these third parties would use their own subcontractors as well. And it's really hard for the financial institutions to track down the chain in terms of service provision. So it is not a once and for all good enough exercise, although it may be helpful to have certain degree of due diligence to start with. And secondly, the challenges include that the international financial institutions have footprint across the globe, and their subjective requirements, which are very different. And technology and data regulations are fast developing and changes a lot. There will be inconsistency in some areas, for example, in data breach incident response. In the case of in some jurisdictions in Asia, for example, under the rules of Monetary Authority of Singapore, then it will be 1 hour for notification of any data incident. But there may be some cases where the financial institutions are subject to a less stringent requirements. So these also present challenges when the global financial institutions try to work with third-party vendors or partners, because while they are subject to really stringent requirements, how they are going to flow down these requirements with their third parties, partners, or vendors located in various jurisdictions is presenting different degrees of commercial discussion and how this is going to be effectively managed. And thirdly is the reputational legal risk. Ultimately, the customers will only know about their the primary service provider as the financial service institutions, and the regulator will only, if any, if the fines and any penalty will be imposed only on the financial institutions. And so reputational damage and real legal consequences are something that the financial institutions needs to look after when they consider using third-party vendors and sharing data with these third parties.
Those are some pretty significant challenges and risks that you highlighted there, Frankie. Just sort of a flip side, what are some of the best practices that you advise for effectively managing those challenges and risks?
Yep, I think to effectively manage these challenges, of course, I briefly mentioned the due diligence questionnaire, and it is a process that we have witnessed from our client. It's just keep on being updated because throughout the past 4 or 5 years, for example, in the past, the sophistication or the level of capabilities about a third parties using generative AI technology and knowledge will not be something in a due diligence process that the financial institution would want to know about. But with the advancement of technology, somehow the due diligence process undertaken by the financial institutions on their third-party vendors and partners need to be updated as well. So keep updating the due diligence process is one of the tools or measures that we have seen in the market is being practiced by our clients. And secondly, it's really about staying flexible in terms of the contractual relationship between the financial institutions and its third parties. Like, for example, have a very well-drafted change management clause to allow an effective documentation and discussion process to manage any change in the original contract to procure any technology services, and also clear service level agreements to avoid any unclear points that are brought about by what we can foresee from the day of the entering of the arrangement to perhaps 2 to 3 years at least. So a bit of future proofing in terms of managing this risk and entering into this arrangement would be necessary, as well as having flexible and a good process in terms of having liability clauses and termination and exit arrangements. For financial institutions, we do appreciate that it is quite hard and it's quite sticky for financial institutions once they onboard and rely on the services provided by a third-party vendor. It's the best case is not to change because it works, then it should continue to be working. But if things happen because of regulatory requirements and changes, it should be flexible enough in terms of the contract to permit the financial institutions to have a good faith discussion and dialogue with the third parties vendor to the transition and how to manage and mitigate any risk brought about by these third parties arrangement as well as any data incidents.
Really insightful, Frankie. Thank you. One more question for you before we go. I'm curious to hear your views on some of the broader digitalization trends in banking, whether for digital banks or legacy financial institutions. How do you think AI, digital currencies, and other rising technologies will shape the financial services landscape in the period ahead?
Well, I think in the coming period, these emerging technology, including AI, blockchain, distributed ledger technology, is going to be more a common part of the basic of technology of what financial institutions are procuring. So looking back a little bit, 2 or 3 years ago, we've seen a cautious side of the financial institutions in terms of talking about adopting AI, generative AI in particular, and using blockchain because of the risk involved in the case of blockchain of decentralized data or decentralized technology management. In the case of Gen AI, because rely on third parties on the cloud facilitation using the large language model. However, in the more recent times, we're seeing that it's not a matter of like being just cautious. It's about whether the financial institutions can find a way that complies with their requirements and regulations, and while adopting it as much as possible to facilitate their own employees to work efficiently and effectively. And we have been recently advising a number of our financial services clients on not just adopting the generative AI technology to improve efficiency internally for use by their personnel globally, but more of using that to create their own end customer case facing products, for example, feeding in data to the Gen AI large language model service to provide investment profile or investment suggestions. Of course, we are still at the early stage, and but we are seeing the attitude change, and whole risk profile is pretty much still involving risk, but then we have seen financial institutions getting more sophisticated and in equipping and themselves in adopting this technology. And we're seeing globally, the regulators are actually issuing guidelines on risk assessment and what are the high risk kind of use of these emerging technology in the sense of Gen AI or blockchain. Even for the high risk use of these emerging technology, they are not totally prohibitive, but with more caution or manual oversight. So with these regulators kind of welcoming gesture to encourage use and adoption of the emerging technology, as well as generally the financial institutions clients are getting more sophisticated and comfortable with adopting this technology, we're just seeing more efficiency in the coming time. And on digital currencies, regulations globally are rapidly changing. In the case of Hong Kong, where my team is based, the new stablecoins ordinance will become effective from 1st of August, and it is going to be the first licensing regime in Asia for regulator to grant license for financial institutions to issue stable coins. There is a lot of interest in it, and we're seeing not fear or something to be frowned upon, but really a welcoming gesture. So it again reinforced the message that we're just seeing more adoption and welcoming of these improvement in efficiency.
So interesting. Thank you, Frankie, for being with us today, and to Brian as well. And of course, our thanks to Matthew Allen, our colleague, and our guest, Carl Hollingsworth from Mox Bank, for giving us so much good food for thought. Thanks for joining us, and please join us next time for more Hot Takes.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.